Hello everyone, welcome back to my YouTube channel. In today's video, I will talk about how to start dividend investing in 2020 during the recession period of time and right after the stock market big crash. So in today's video, I will talk about the basics of dividend investing, the reasons to become a dividend investor, how to snowball your dividend income. Then I'll talk about what dividend growth stocks to buy, the pros and cons of each category. Then I'll go over with you which brokerage or online platform should you choose when you start your dividend investing, and also where to find the stock quotes and related stock informations. Last but not least, some of my stock picks of the best dividend stocks that can sustain the recession and then continue to perform well for the future years to come. You can support this channel by giving a like, comment, subscribe, and hit that notification bell. So without any further ado, let's get started. First, I will start my video by direct quote from Warren Buffett, the best value investor in the world. He said, "Plant your dividend investing trees today, so you have a forest of dividend growth later on in life." What are the dividends? Dividends are the payments made by a corporation to its shareholders, typically as a form of profit sharing. However, the payment of dividends is not required by law. That's why the companies can choose to raise, lower, or eliminate dividends at any time. That's why in the past 2 weeks, you see some companies holding their dividends, some companies cut their dividends, some companies even eliminate their dividends. Therefore, it's up to you, the investor, to choose the right stocks or investment ETFs to make sure they will pay your dividend even during this recession period of time. In United States, most corporations pays out dividend on monthly, quarterly basis. Some of them pay on the annual basis, and very few of them pay on the biannual basis. The dividend yield is not a constant number as presented in this formula. When the annual dividend stays the same, it depends on the stock price. When the price is going down, the dividend yield will go up. When the stock price is going up, the dividend yield will go down because it's an inverse relationship. Also, when the dividend payout increase, the dividend yield will increase as well, providing the stock price doesn't change. In reality, dividend can be increased or decreased. The stock price constantly change, so the dividend yield can be changed on daily basis. So you cannot simply based on the high dividend yield to determine which stock to buy. For example, if you see one of the stock used to having a dividend yield at 3%. All of a sudden, one day, it went up to 23%. You cannot just say, "Oh, wow, this is a great stock for me to buy." You cannot say that because the stock price can tumble going down so much to jack up the dividend yield. So you have to do comprehensive study to determine which stock can sustain the crash, and then the price can reverse, and then the dividend can be safe for the company to pay you in the future. So what are the reasons to become a dividend investor? First of all, dividend stocks have historically outperformed the market over a long period of time. And also, the best reason for you to become a dividend investor is to generate rising passive income over time. Investing in high-quality dividend growth stocks with long history of paying the rising dividends makes it very likely that your investments will pay you more every single year. Number 3, how to snowball your dividend income. It's actually by 3 methods. First one, dividend growth. When the company increase your dividend payout year after year after year, so as your dividend income. Second is by DRIP plan. DRIP meaning dividend reinvestment plan. After you receive each time dividend payout from a company, you reinvest or compound it into your investment so your future dividend income will increase. Third, you snowball your dividend income by invest regularly. For example, you regularly invest into your dividend portfolio on weekly basis or monthly basis or half a year or yearly. In that way, when your investment portfolio base increase, so as the dividend income. Let me give you a simple example to show you the snowball effect of your dividend income. Let's say if you start your dividend portfolio at $10,000, it pays out about 3% dividend each year. So your first year dividend earning is $300 per year. But if the company increase their dividends by 6% per year, after 10 years, your dividends will become $538 per year without adding any money to it. If you drip or reinvest your dividend on yearly basis, then after 10 years, your dividend earning will become $710 per year instead of $538. Imagine if you also invest regularly. For example, you put in another $100 per month into this dividend portfolio for 10 more years. On the other hand, also you'll increase your frequency of your dividend reinvestment. Let's say on monthly basis or quarterly basis or whenever you receive the dividend. Then after 10 years, your dividend earning could be astronomically higher than $710 per year. Number 4, what dividend growth stocks to buy? There are 2 ways to do that. You can either indirectly invest through ETFs. ETFs stands for exchange traded funds. Or you can directly invest through individual stocks. ETFs gives you immediate access to a diversified portfolio of dividend growth stocks. They are timely effective as well, so you don't have to do any research of any individual businesses. All you need to do is just to put the money into that ETF and then you are done. The downside, however, is the expenses ratio. You have to pay the expenses to the fund manager for them to manage your ETF for you. So your returns or income can be reduced. Sometimes the expenses ratio can be very high for some ETFs. Also, one ETF could host from 50 to hundreds to even thousands of stocks in that particular ETF. And then you have no right to say anything. You have no voting right whatsoever to decide which stock to be invested in that ETF. On the other hand, if you decide to invest directly through individual stocks, the advantage of doing so is that there is no management fees whatsoever, so it's very cost effective. Second advantage is that you know exactly what you're invested in. It can be very helpful trying to hold them through the recessions, especially now. For example, if you hold a Coca-Cola stock, through a recession, you know the company will be fine in the end. But investing in ETF, it's less clear. You're not sure about it. The downside of investing in individual stocks is that it takes a lot more time for you to do the research, to find the businesses with competitive advantage, and also will be traded at a fair or better prices. You cannot just get in at a peak time. You have to wait for the right moment to get in. You also need to look at the balance sheet, understand price to earnings ratio, and also you have to study the stocks that has long history of dividend increase every year. And also you have to choose the stocks with dividend yield that you feel comfortable with. Not too high, not too low. So there's lots of study for you to do before you start the dividend portfolio. Number 5, which brokerage or online platform for you to choose when you start dividend investing? You have to choose with 3 criteria. First, auto rebalancing. Second, fractional share buying. Third, drip plan. Why fractional buying? Because you don't have that much if your stock account is very small. For example, you can only invest $100 per week, but some stocks price can way over $100, like even $1,000. In that case, you cannot even afford to buy one share of that stock. So you have to look for a platform can offer you to buy fractional of a share, like say 1/10 of a share, 1/20th of share when you have $100. The drip plan is important because you can compound your dividend to snowball your dividend income. So I have a few brokerage for you to choose from. E-Trade doesn't offer fractional share buying, but it has a true drip plan, meaning anytime when a stock pays out dividend, it will automatically buying the fractional share of that particular stock. You only need to assign E-Trade to which stock you want to do the drip plan, but that's easy. Second is Charles Schwab. Charles Schwab offers fractional buying and drip plan. However, it doesn't have auto rebalancing function. Robinhood can allow you to buy the fractional share of a stock, doesn't have the drip plan, doesn't have auto rebalancing. M1 Financing has all three. It has auto rebalancing function, allow you to buy the fractional share. Also, it has a drip plan. However, this drip plan is not a true drip plan, meaning it doesn't drip back to that particular stock. It's a portfolio-wide drip plan, meaning if you have $10 dividend payout by one company, and if you hold 10 stocks in that portfolio, that $10 can allow you to buy fractional shares of all 10 stocks to be compounded. Eventually, you will also have income growth of your portfolio. So M1 Finance, I think, is the best choice for someone to start out with a small account. I have a link down below for you to join. If you select my link to join with M1 Finance, you will receive a $10 free gift from M1 Finance once you load the account with $100 to start investing. If you join M1 Finance by yourself, you will not receive that $100 bonus. Number 6, where to find the stock quote and related information if you want to do the research. You can find those information from Google Finance, Yahoo Finance, and Nasdaq.com. And also those brokerage and the online platform I just mentioned, they offer all those free information for you to study the stock, for you to start your investing. Number 7, how to stock pick during recession that we're in. To pick the winners, that's my answer. You cannot afford just to buy any stocks used to pay lots of dividends because you're not sure if they're facing any financial problems. Like you don't want to go into restaurant stocks when everything is closed. You don't want to buy airline stocks or hotel stocks when nobody is flying, nobody go to hotel. You cannot buy too much bank stocks at this time because we're facing recession. And then used to be very good REITs stocks you have to be very careful with because the real estate market will go down. So try to avoid all these dividend trap or dividend paying stocks that are gonna get you into trouble. Pick the winners and stick with the winners. Number 7, what are the stock picks if you just start out dividend investing? If you are looking into collect dividends from your stock purchases, you will have to think big businesses. That is, large corporations with a long history of financial stability and low volatility are most likely to pay out dividends after you purchase them. During the recent pandemic and recession, 2 sectors performed the best. One is healthcare sector, the other is the technology sector. From the healthcare sector, I'll pick Johnson & Johnson. It is a solid company. It increased its dividends by 6% recently, as well as have a fantastic first quarter earnings report. Also, its price target being increased just today by the analyst. It is a great company to hold on to. Also, it is in the process of producing the much needed vaccine to treat coronavirus. From the technology sector, I will choose Microsoft and Apple for obvious reason you guys all know. On the other hand, due to the 5G technology is around the corner, I think Verizon is also a great stock that will continuously paying you the dividend you need for your investment. On the other hand, 3M, Procter & Gamble are the great stocks to hold on to because they have long history of increase their dividends. Procter & Gamble just recently increased the dividends by 6%. 3M produced the much needed N95 mask for healthcare workers as well as other people. Its current dividend paying is at 4.15%. So these two companies are the solid companies to hold on as well. On the other hand, Walmart, nobody can miss Walmart. It has retail section, wholesale section, and then online section. Wholesale section is Sam's Club's. Online section really enables people staying home, ordering, and avoid to go out to contract the virus. It's recently break out from its all-time high price. It's a great company to hold on as well. On the other hand, during social distancing, people stay at home doing nothing, watch TV a lot. They probably just reaching out and then grab the soft drinks. So I think Coca-Cola and Pepsi will be the great company to add on to your dividend paying stock portfolio. If you want some defense stock, I think Lockheed Martin LMT is the one that you should keep in your portfolio because it's constantly getting government contract for its programs. Current dividend is paying at $2.40 per share. It has a 17-year of consecutive dividend growth history, so it's a great company to hold on to. In addition, if you want to add some ETFs to increase your diversity in your portfolio, you can consider Vanguard VOO and then BND. VOO is a S&P 500 ETF. It has 514 stocks in the VOO. The expenses ratio is extremely low. It's only 0.03%. Current dividend yield is 2.11% with a payout ratio is only 8.48%. That means this ETF has potential of increase its dividend for your portfolio. If you also want some bond in your portfolio to offset the market crash, you can consider BND. BND is a Vanguard total market ETF. It owns 17,786 bonds inside this ETF. Current expenses ratio is also very low, 0.04%. Dividend yield is at 2.56%. I will end today's video with another Warren Buffett's quote. He said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. If you like today's video, please do not forget to subscribe, like, and comment, and share the video with whoever you think will be benefit from today's video. And also do not forget to smash that notification bell so you'll be the first one to know when my new video comes out. Thank you.